I mean, we went from, oh, 5 of my homes are unoccupied, but it's fine because housing prices are going to go up another $50,000 in the next couple months, to I've got one place and I'm renting out 2 of the rooms. I mean, we're hyper using real estate rather than and hyper using the things we own. On my off hours for my job, I drive for Uber to get another couple $100. It's the complete opposite of what the mid 2000s were like if you were involved with a grift. The grift then was this participating in the system where there was easy money, but it was all going to fall apart. The grift now is just exploiting yourself harder and more with just whatever little unused things that are in your life. It's the grift of austerity rather than the grift of plenty.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For as little as $1 a month, you can get early access to all our episodes and patron-only episodes. A big thank you to all our supporters so far. At the beginning there, you heard our guest this week, writer and research director for the Modern Money Network, Nathan Tankus. And we're going to be talking to Nathan in a moment about the great financial crisis of 2007-2008 with a view to understanding our current crises. For an introduction to MMT, from basic principles to policy prescriptions, you can listen to our first 4 episodes. But if you want to dive in here, I think a good thing to bear in mind at all times when it comes to finance is Hyman Minsky's observation that anybody can create money, but the trick is getting people to accept it. So just to unpack that, money is an IOU, which is a promise to pay something in the future. And when a person takes out a loan at a commercial bank, whether it's to buy a car or a home or something else, the customer's promise to pay the bank can be viewed as money that the customer has issued to the bank. And that money, that IOU created by the bank customer, is traded for the bank's IOU, which it creates out of thin air by an accounting entry. And the bank's money is far more liquid and more widely accepted than the customer's money, because the bank is acting as an agent of government when it lends money into existence. If you want to know more about this aspect of banking, known as endogenous money creation, you can listen to our episode 43 with Sam Levy. So as I see it, the great financial crisis was significantly rooted in a combination of 2 things. One is what banks are allowed to do with their customers' IOUs, and the other is a cast iron law of finance, often spoken about by Professor Michael Hudson, which is that a debt that can't be paid won't be paid. Financial products designed and created to pay out when debtors defaulted on their impossible-to-pay debts sharply accelerated an already ongoing transfer of wealth from the poorest in society to the richest. Does it have to be this way? Are we locked into a cycle of boom and bust with no escape? Modern monetary theory economists say no. The laws governing money creation and wealth distribution are human-made and can be changed. As MMT founder Warren Mosler puts it, there is no financial crisis so deep that it can't be dealt with by a sufficiently large fiscal adjustment. So more recently, we're seeing headlines about various governments passing large economic rescue packages and increasing their deficits by record amounts. Headlines with the seeming objective of teeing up the public for crushing austerity. But what these headlines gloss over is why a government like the US can pass trillion-dollar rescue packages. And it's because monetarily sovereign governments like the US, like the UK, Japan, Canada, or Australia issue new currency every time they spend, rather than recycling tax money collected from the private sector. And so, to paraphrase Professor Stephanie Kelton from her book, The Deficit Myth, talking about the government deficit without talking about what's happening on the other side of the ledger is like reading out half a football score. It's like saying Manchester United 3. As a side note to our American listeners, 3 goals is a pretty good result over here because we play this crazy version of football where you're not allowed to pick up the ball and run with it. Anyway, when it comes to government spending, you need to know when the government deficit increases by a certain amount, private sector savings increase by the exact same amount. Every year in the UK, the government issues a number of pounds into existence when it spends, and it subtracts a number of pounds out of existence when it taxes. The difference between the first number and the second number gets called the government deficit, but it's also the private sector surplus. So when the headlines are saying that the government anticipates a £300 billion deficit, they're not telling you the full score. The full score is government minus 300 billion, private sector plus 300 billion. What a result for the second team. That's our team. Go privates. That probably came out wrong. Anyway, to help us better understand things we should be paying attention to, in March 2020, Nathan Tankus started a donor-supported newsletter called Notes on the Crises. And in just a few short months, the newsletter's become so popular that now, as of July 2020, he's able to transform it into a full-fledged publication dedicated to macroeconomically informed investigative journalism. If you'd like to help him with that transformation, I've linked to his writing in the show notes, and that's where you can financially support not just his journalism, but that of his guest contributors. And during the interview, Nathan gives out a discount code for MMTers because you're worth it. Also in the show notes, there's a link to where you can support this podcast by going to patreon.com/MMT podcast. Support starts at $1 a month, which is 80 British pence at the time of recording. You get early access to all our episodes and patron-only episodes where you can ask me and Patricia MMT questions. Your support really helps keep the show going and our lives going, so thanks as ever for your financial support and for recommending us to other people and for the time you put into understanding MMT. Economics is an area where the mainstream media's credibility deficit is on an unsustainable path, and it's up to us to fix it. Let's dive in. Welcome one and all to the MMT podcast. I'm Christian Riley here with Patricia Pino. Hi, Patricia.
Hello.
And we are delighted to welcome back to the podcast Research Director at the Modern Money Network and prolific writer with bylines in Financial Times, Business Insider, Naked Capitalism, The Appeal. Please welcome back Nathan Tankus. Great to have you, Nathan.
Great to be here.
So we wanted to do an episode where people came away from it with an understanding of banking crises. And I thought a good way to start would be to talk about what triggered the financial crisis of 2007, 2008. Obviously, there was a chain of events that started before 2007. Could you say what happened?
Sure. So, on a superficial level, people feel like they know what happened. There was a housing bubble. People said that housing couldn't go down. But, of course, housing could go down. The bubble popped. Wall Street collapsed. And it reverberated around the world. And this story isn't necessarily wrong per se, but it misses a lot of the details of what actually was going on in the United States and specifically on Wall Street. The U.S. and other countries have had real estate booms before, and they've had real estate busts. I mean, in the 80s and 90s, we had the savings and loans crisis. We had massive asset price inflation and then deflation. And those crises were bad, and they took down the savings and loan industry, and they had a big effect on the banking system at the time, but they weren't a global crisis. So it actually doesn't really, not necessarily obvious that even a housing bust would have been a global crisis in 2008. And to figure out why it was a global crisis, we have to look elsewhere. And we have to look what Wall Streeters call structured finance or financial engineering. And that's really where the crisis was. The crisis superficially was about real estate, but it really was a crisis about the financial innovations that are also legal innovations on Wall Street. So what were those? Well, at the most basic level, there's the mortgage-backed security, which is just a security where, if you think about it, you have an individual mortgage. Well, I don't like to be tied to what's going to happen to this individual homeowner. I don't want to be invested in just this. So you then get, one way to insure ourselves against losses, we'll have a portfolio of mortgages. But then you're still exposed to each individual homeowner and what's going on with them. You're just exposed to a lot more of them. So one way of dealing with that problem of going, hey, actually, I want to get rid of some of the riskiness. I don't want to be directly exposed to these bums, is saying, let's put all these mortgages into securities and we'll sell securities to different investors. And those different securities will get paid out different amounts, but also have different risks. So, at the bottom layer, you're really exposed because if default rates on that portfolio of mortgages rise, you'll get totally wiped out. But there's this other layer that, is the top tranches. A whole bunch of other people have to get wiped out before you see any losses. And in the sort of like common storytelling of this period, people generally think this engineering totally collapsed. And, the theory behind this where you could be safer by having a whole bunch of people who would lose before you lose, totally failed. But it didn't actually totally fail. So even this first layer of financial engineering, structured finance, Wall Street magic, we might have all sorts of other criticisms of it. And this process might have led to people making mortgages that were not as sound as they could have been or should have been. But nonetheless, the basic theory here, where the top layers were mostly protected from losses, even in a big crisis, held fast. We have studies that, like, basically, on average, the AAA layer of mortgage-backed securities lost maybe 0.5%. It took about 0.5% of losses, which it shouldn't have as a AAA security. A AAA is supposed to be as good as a government bond, which obviously it wasn't. In some sense, couldn't have been. But it isn't this total loss that we think of when we think of the financial crisis. But people aren't wrong that there weren't these huge unexpected losses that blew up everything. To look at there, you have to look at basically, it's not like financial engineering or structured finance or Wall Street magic that inherently is going to collapse. What happens is they went on like basically a fraud boom where they added a whole bunch of nonsense on top of this basic product.
Let's back up because you know me. I like to go really elemental. I'm sorry if it's too elemental for any of the listeners. Right. So let's just start with a mortgage holder.
Yeah.
So, a person who goes to take out a mortgage. I take out a mortgage for $100,000. I'm promising to pay $100,000 plus interest in installments into the future. So if you take out the mortgage, this is a way that's helped me to think about it, but it might be wrong. You tell me. This promise to pay, it's my liability, but it's the bank's asset.
Yeah.
So my promise to pay is like money that I've issued to the bank in a way, and they can do what they want with it. Yeah. Does that sound about right?
Yeah. It's in their pocket. It's, it's an asset to them. We make this agreement, we sign 2 pieces of paper. And when we both sign the piece of paper, suddenly you have an obligation to me and I have an obligation to you. But the thing is, the bank's obligation is a much more trustworthy obligation. It's a much more valuable obligation in a lot of ways. So I have to make a lot of special promises in addition to just like, hey, here's my IOU. Don't you love me?
Yeah.
To get you to be willing to hand over $100,000 of your IOU for $100,000 of mine. I need to make a bunch of special promises to make my IOU worth the same as your much better, much more liquid, much quote unquote safer IOU. And one of the big promises in there is interest, but for a mortgage, another big promise is that you can foreclose on my house. So there's these 2 layers of protection. I'm supposed to make payments to you and make interest payments when you're not necessarily making interest payments to me. Probably not. Probably even having transaction fees for using the money in my account that you just gave me. And you can foreclose on me if I miss a payment. So I can pay you thousands and thousands of dollars of interest, $50,000 of interest. But if I don't fully pay off the mortgage, then you can take the house and make back your whole loan from that.
Is the reason why the bank accepts your IOU, it's also because the government is enforcing the repayment of the IOU? Is that a good way of seeing it?
Sure. I mean, if you think about a foreclosure, what is a foreclosure? Foreclosure is a sheriff or a policeman knocks on the door and says, you don't have the right to live here anymore. And they kick you out by force. And people do die getting forcibly removed from a home by force. It's a tense situation where, emotions are running high and you're being put in direct conflict with armed bureaucrats, which, as we've seen, is a circumstance that is ripe for abuse.
Okay, so we've got our mortgage. The next step is securitization. So what is that? What happens between you making the promise to pay and that turning into a mortgage-backed security?
Well, there can be a whole bunch of different steps. For the simplified, just imagine a bank is making a loan, and we exchange our IOUs. I get money in my account, and then after that point, the bank takes our mortgage and sells it off to some bank on Wall Street who puts that mortgage in a trust. All this is based on legal instruments like trust. Like you might be a beneficiary of a trust when someone dies. Well, Wall Street also uses trust to set up special vehicles to make securities out of, because they don't want to be on the hook themselves. They want it to be the obligation of some other entity. They're running it, but formally it's a mortgage that's in a trust, and the trust is who owes investors payments, not the bank itself.
And they used to, in the old days, I actually don't know when the old days ended, but it used to be more the case that loans were originated for them to hold till the loan was amortized. Then we switched to this system where loans are originated with the express purpose of selling or getting rid of, yeah?
Yeah. I mean, let's say, to start with this, mortgage-backed securities is actually a government innovation.
Right.
It's innovation of government. We think of financial innovations, this big private sector thing, but the mortgage-backed security was a way of, at the time, making mortgages safer, because you had in the Great Depression, you had mortgages that, similar to mortgages that originated in the 2000s, mortgages that would have balloon payments, that would be 15-year, 10-year mortgages, and then, suddenly something quick happens, there's small change in what you think your income is, and suddenly you can't pay your mortgage and you get foreclosed on. So the idea at the time was, we'll make or you have a mortgage where the interest rate goes up because it's tied to some market interest rate. So the idea behind mortgage-backed securities originally was, we'll set up these state-owned enterprises, Fannie Mae and Freddie Mac. This will give banks an incentive to make standardized 30-year fixed-rate mortgages, because they can potentially sell them off to the government. And even if they don't end up selling it off to the government, it becomes this sort of standard throughout the industry that, a good, safe mortgage is a 30-year fixed rate mortgage. So that's where it started. And then at a certain point, there was a realization that you could do the same thing with private investors. There was profit to be made in creating a security that would be sold off to private investors that wasn't government guaranteed. But on the flip side, if you added enough tranche layers, what I was describing before, where other people could take losses, where they'll take losses first, that was a way of, well, we don't have the government guarantee, but this provides you something almost as good as guaranteed. We're guaranteeing you that there are losers before you. And that's the basic way that this product worked. Now, that said, since the private market collapsed, the private label market, as they call it, collapsed after 2007, 2008, there's been a return to making a mortgage that you just hold on your books. That's more like, if you look through the statistical data, I think it's that the FDIC put out, I definitely was looking at a report recently, portfolio mortgages, which is mortgages you're just holding on your own books, have risen considerably. And throughout it all, there's still the Fannie Mae, Freddie Mac mortgages that are going through that pipeline. So it's not all portfolio-based mortgages, but we've definitely seen a return to that as the private portfolio market, as the private label market collapsed.
So just one question. Sorry, it sounds really trivial to ask, but so when you're repaying your mortgage in installments, because the institution that you now owe money to has changed by a degree, what's happening to those, in our country, pounds, but in your country, dollars? What's happening to those pounds or dollars going out of your account by direct debit? Now, because you set up a direct debit or whatever with your mortgage lender, but even though who you owe changes, I don't recall at the time I've had a mortgage having to change where I'm sending the money.
What often happens is that there's a mortgage servicer, and often the mortgage servicer is the mortgage originator. So that's like what keeps stability in that process is. But it can change. I mean, there were definitely people who suddenly it was like, oh no, you have to send this payment to a new place now. So you would have servicer that would change, but that's a lucrative business in and of itself, which also led to a whole lot of problems, which we can get into later. But yes, this is a big component of it, is that the mortgage changes hands, but there's this mortgage servicing layer of who you're supposed to send the payment to, and they're the ones supposed to process payments and then send along proceeds to the trust. But one of the key pieces is they take their fees out of your payments first. So the trust and thus the investors get money after you've taken your fees out, and the servicer basically has control over basically their own compensation, which we can get into later, but you can imagine led to a whole bunch of problems.
And we are actually talking about your article, which we'll link to, called
Is There Really a Looming Bank Collapse?
Now, next thing we've got to talk about is how we get from mortgage-backed securities to collateralized debt obligations.
Yeah. So we've got this one layer. We've got the mortgage or portfolio mortgages. The bank has sold it. It's in a trust. And then the trust has sold securities to a whole set of investors. And the securities have these different tranches where one is the high up tranches where they're sold to people where there's a whole bunch of other people who are going to take losses before you. And then there's these lower tranches where you're going to get a higher yield, a higher return for now, but you're the one who's exposed if default rates on these underlying mortgages rise. You're the ones who are going to get wiped out. So we're at that first layer. We basically have one layer of structured finance here. We've got the individual mortgage, it's gone in a trust, and now there's these securities. And, we might not like this in certain ways. This might have weakened banks' underlying interest in underwriting the mortgage. But the structure basically works as it's supposed to. And even if, the people at the bottom of this of what's going on are more likely to take losses than they might be expecting, they're still getting a high return out of it for now. It's not the biggest deal in the world. It's certainly not a global systemic crisis, just at this one layer. Where you get the global systemic crisis is you add a second layer. And the second layer comes in because, if you think about banks, they're really just like glorified used car salesmen. And there's nothing that's more like a used car than the bottom tranches of these mortgage-backed securities. Because, in reality, we think, oh, there's got to be some sucker there who's going to be buying for 15, 20% returns, and then they're going to lose everything. There actually weren't that many of those suckers out there. And especially if you think about all these institutional investors, where they're only legally able to invest in certain types of securities, these bottom feeder stuff, the leftovers, the crap, doesn't have a high rating and isn't going to get, quote unquote, the attraction of those quote unquote dumb money. So some people on Wall Street had a brilliant, evil, but also brilliant idea of, well, what if we just took all this crap at the bottom, took our, A and B and BB and our lower tranche parts of the mortgage-backed securities, what if we put them in turn in a trust and sold new securities based on these lower tranches? And we'll call it a collateralized debt obligation. And that's the big thing here is now we have two layers. We have a mortgage. The mortgage goes into a trust. The trust issues securities. Some of those securities, have a whole bunch of other securities that have to fail before they'll fail. And then we have these lower rated securities, these lower level securities that are more likely to take losses if default rates rise. And now some Wall Street people have put those securities in a trust and then have that trust issue new securities. And then the key point in this process is, well, if you look at it superficially, the same logic for why the first layer works should work here. Okay, there's some high up tranches that are protected by other tranches taking losses. And so superficially you can be like, well, you have all these other people who are going to take losses first. That seems unlikely. So give us our AAA rating for our top tranche. And then, this is going to work just like the AAA mortgage-backed security is going to work. The problem is that's nonsense. The problem is you can't actually, in the same way that you can't like make food taste good by putting it all together and re-cooking it, as they said in The Big Short, 3-day-old tilapia, you can't actually do that. But it's also for a very specific reason. The mortgage-backed security works because they're actually underlying loans that this is based on. That, the investors are buying a structured product, but the things that are in the trust actually are underlying mortgages. And even if their default rate rises to 10, 15%, that's not necessarily going to be 100% default rate. The top tranches are protected. But that logic of you're protected, you're diversified, even if you're all investing in mortgages, doesn't apply to a structured product because the structured product has been designed to fail. We'll go back to the mortgage-backed security. At 8, 10, 12% default rate, all the lower rated securities are supposed to fail. That's what they're designed to do is you get a high enough default rate, these fail to protect the principal of the higher tranches. It doesn't matter how many of these securities you put in a collateralized debt obligation. You could put every single lower rated tranche in the world in those securities. You could, sell it for $1 billion, but it's $1 trillion worth of lower rated securities. It doesn't matter if the default rate goes up, if overall default rate on mortgages as a whole goes to 8, 10, 11%, all those CDOs are going to get wiped out. Every single last dollar is going to get wiped out because there's no underlying mortgage. You can't rely on, the either 85% are going to keep on paying because the whole point of these securities is to fail. It can't be emphasized enough. These securities are designed to fail if a mortgage crisis happens, and that just isn't true about the first layer of mortgage-backed securities. So doesn't matter, how complicatedly you structure it, as long as the underlying assets in the trust are these lower rated securities, in a crisis, they're all going to fail. And that's what happened. Over 14,000 CDO securities failed, and they were designed to fail. But the superficial logic plus, the highs of the time and straight up fraud convinced the rating agencies to give it AAA ratings and were able to dump this onto dumb investors and kept this whole party going. And then on top of that, they took bets on top of that, which we can get to in the next.
I was about to mention those actually, because in the movie, The Big Short, they mentioned that there was an awful lot of fraud going on with the people that put the AAA rating being paid by the very banks that had an interest in selling these securities. So I think that has a lot to do with it. But also, was there an element of, all this system was relying on more and more mortgages being issued out at the bottom layer? And I'm sorry, maybe I'm branching off here a little bit, but, even though most of the reason was fraud, is there also something to say about, why were people willing to accept such higher mortgages? Was there a link with austerity there? Was there an inherent need? Would they have not done it otherwise? Was it just the fraud, or was it also something else going on?
I think when you have a need for a decently rated return, a return that is going to meet your benchmarks, then it's easier to convince people than if you're satisfied with the returns you're getting. And so you have, an environment where there are sustained lower interest rates for a long period of time. And you have these institutional investors who are looking for 7%, 8% returns in order to, have a quote unquote fully funded pension, which is kind of a nonsense concept. But, if you're an institutional investor, you're mad at, or you're a hedge fund trying to provide returns, or you're some other entity that's trying to, meet the return, you're a university endowment, so on and so forth. There's a lot of pressure to meet your benchmarks, and it's easy to fail conventionally. If it's being AAA rated, if everyone else is getting it, even if ultimately there are big losses, there's this pressure to get involved in it. And there's especially a pressure because even if you personally know better, these industries are all relative industries. They're all where you're comparing to how well everyone else is doing. The big perniciousness of frauds is when a fraud is going on, the people who aren't committing fraud or aren't investing in junk mortgages look like the idiots, because they look like they're getting subpar returns and they're doing the worst in the market because we're just investing in this other stuff that's 4 or 5%. That guy's getting an 8-9% return. He's getting a big bonus. And, the trustee or, the college trustee or, some other, rich person with a trust fund comes in and goes, all my friends are making money. Why aren't we making money? And they think it's inherently, people are thinking you're the idiot rather than everyone else is going on. And so this is actually, something that, gets talked about. There's this sense, no one saw a housing bubble coming. Yeah, everyone thought that housing prices wouldn't go up forever. Not true on Wall Street. People knew what was going on Wall Street. And a lot of people, by the time of like late 2004, 2005, held out of the market. And normally what happens if you start getting a lot of people who aren't participating, mortgage interest rates would rise, and that would sort of choke off what was happening. But this game, this CDO game, and this is the part that The Big Short doesn't communicate, and also leaves out a big part of like actually the shorts were contributing to the problem, is various ways of shorting the housing market and making bets on the housing market would either through a hedge or so on and so forth require you to buy like the bottom securities in a mortgage-backed security. One of the ways you could sort of synthetically engineer more demand for mortgages for more mortgages to originate and keep this process going was through the collateralized debt obligations and making more collateralized debt obligations, because for you to get collateralized debt obligations that you would then bet against, those collateralized debt obligations have to be filled with lower rated mortgage-backed securities. So you need to buy a whole bunch of those securities to put in a collateralized debt obligation in order to bet against it. And you couldn't find enough collateralized debt obligations just out there in the world to bet against. So you needed to create things that you would bet again, that you would sell off to dumb investors, and then you would then bet against by buying these credit default swaps, which are basically just like unregulated fire insurance. Like if this security fails that I don't own, or I own, but I own 1/100th of the value that I'm betting against it, then you're able to get this big return because the other guy's house burns down. And thus, of course it's unregulated. So you do whatever you can to make the other person's house burn down, but the other person's house is the American mortgage market. And so that's the devious thing. That's the crazy thing about what was happening is participating in these markets and trying to bet against it involved creating more and more demand for mortgage-backed securities. And you needed more and more mortgages to fill up these collateralized debt obligations. That's the craziness. And so what happens, to get back to where I was originally going with that, what happens is you have a whole bunch of people who are sitting out of this market, and then you have a whole bunch of people who are making money. And people aren't exactly clear of how they're making money, but they know they're making money. So your boss comes down and says, how are you not making money in mortgages? Because remember, if you're the mortgage desk and you're not involved with mortgages, that means you're not making any money that year. There's no deal for you to get a bonus based on. So you're actually the schmuck. You're the schmuck who's risking your job by trying to keep out of the mortgage market. So, of course, a lot of people reluctantly get back into mortgages because of what's going on, and that keeps things going on much further than it would otherwise, and builds up this behemoth that is gonna fail in bigger and bigger and bolder.
So you came up in your article with a very colourful metaphor, and I'm going to say it back to you, see if I got it right. So your mortgage-backed security is you fried up the leftovers and sold them as a gourmet meal in a restaurant. That's your mortgage-backed security. It was something like when your customers eat that and then they get diarrhea.
Yeah, the mortgage-backed security is the leftovers from that becomes a collateralized debt obligation. CTO goes in there, and you've guaranteed that your customer is going to get diarrhea from your food, and then and then you take bets
through some complex mechanism, like some pressure plates in the seat of the restaurant. You've wired the entire city to blow, like Batman supervillain style.
Yeah, and that's the key to understand is if you think about it, you're making bigger and bigger bets where you're going to get paid out a larger and larger amount of money based on these underlying mortgages are going to fail. Well, since we know for every financial asset is a financial liability, the potential, or in your mind, the guarantee that you're going to get a gigantic payout means you're guaranteeing that some other institution is going to get gigantic losses. So if I take a bet and I'm sure that my bet is going to pay off because I've designed the system so that that bet is going to pay off, and I'm going to get $1 trillion from the person I'm betting with, well, I've guaranteed then that the person I'm betting with is going to take $1 trillion loss. And that's the big problem with the system. It's just not possible to take bets that large. You take bets so large that are larger than the economy, larger than how many existing financial assets are circulating in the economy at that time. What in reality you have is a gigantic bet with an institution that's about to fail because of how much they owe you. And that was the huge problem. That's you can't actually make bets that are so big that there's not enough underlying financial assets in the world to pay you back. And that's the reason why you need the government to step in, because they're the only ones that can generate the amount of money that would be involved.
So let's talk about that, the aftermath of the crisis. Very few of the smaller banks that failed actually filed for bankruptcy. Most of them got acquired or nationalized. Most of them got acquired by larger banks or nationalized. Some banks deemed as systemically important were characterized as getting bailed out. But I've heard Warren Mosler in an interview say these bigger banks like Citibank, they were given regulatory forbearance. They were allowed to run with less capital. The regulations at the time said they had to run with, rather than money was given to them. His idea is that the government insured the bank anyway, so the government would have had to pay out the money to make the depositors whole again if they shut the bank down. So I think his thrust is, I might be misinterpreting him, but nothing really changed by allowing the banks to continue. Do you agree with that interpretation?
I agree with that to a certain extent. The complication is that the banks we're talking about are not, they're not just a bank with a bank charter. They're these huge entities with a whole bunch of subsidiaries, and most of the subsidiaries don't have a bank charter. And that's very important, actually. What happened over that last few decades, and actually my piece with John Haskell from University of Manchester at the justmoney.org website about virtual currencies in the shadow of the money market, that piece is in part about this. And I have some other stuff coming out that's going to be writing about this too. But what really happened, one of the big issues that led to the financial crisis, is we basically allowed a new type of entity. We allowed these bank holding companies, which would have the power of a bank throughout the entire institution. We loosened the requirements so that you could have much more what are called inter-affiliate transactions, where different parts of a company are transacting with itself. We usually think, oh, that's a bank. A bank is a bank is a bank. But a lot of our mid-20th century laws are attempting to take one large entity that you think, is just owned by, and controlled by one set of board of directors, shareholders, etc., and carve it up into these many different pieces that are supposed to function semi-autonomously and are going to have different responsibilities and requirements. We basically it was an attempt, not quite to break up these big firms, but to semi-break them up where they would function differently. And what happened since the mid-1990s is those barriers kind of got broken down. And so we essentially chartered a new type of financial institution that would have a bank charter for one of its subsidiaries, and the rest of the entity would benefit from that. And we solidified that even more in the beginning of the financial crisis. So there's Professor Saleh Amarova from Cornell University has a great paper from 2010 about this. There's in the Federal Reserve Act, Section 23A of the Federal Reserve Act, that has these ways that affiliates are supposed to be protected from each other, and you're not supposed to transfer a whole bunch of money between affiliates. And one of the first things the Federal Reserve did was issue a whole bunch of exemptions from those rules in the beginning of 2007. During the 2007 part of the crisis, when there were liquidity problems for the subsidiary of banks that could have been dealt with by the bank part of the subsidiary, where the bank part of the subsidiary, gets liquidity because it is a bank, and provides it to the rest of the institution, they started doing that. And because they started issuing these exemptions is one of the reasons why Morgan Stanley and Goldman Sachs went to become bank holding companies. They went to become bank holding companies because at that moment, there was nothing better than having access to your bank subsidiary. Your bank subsidiary could provide liquidity to the rest of your entity. So it's...
Just dive in there, Nathan. Just say, why is that? Why do banks have liquidity?
They have liquidity because they can borrow at the time, because they could borrow unsecured from other banks. And they had access to a bank account with the Federal Reserve. They could potentially borrow at the discount window, borrow directly from the Federal Reserve, or the Federal Reserve would, quote unquote, merely make sure there was enough liquidity throughout the banking system that it would get passed around. What happened in the financial crisis is that system sort of started breaking down because banks wouldn't be willing to lend to each other unsecured because they suddenly realized, oh, everyone else has the same crappy mortgages on their books. Everyone else is waiting on this bet that's going to pay off from the insurance companies that isn't going to pay off. I don't trust them and they don't trust me. So that system sort of started falling apart. And as a result, the Federal Reserve just started directly lending to everyone. So at that point, that's essentially what they're getting liquidity from. At this point, they're very directly borrowing from the Federal Reserve, and then they're providing liquidity, essentially lending on or purchasing assets from the rest of themselves, the other subsidiaries.
At that time, would another way to have dealt with it be for the Fed chair, I guess, was it Bernanke at that time, for him to just make a public statement saying, everybody relax, just, we're going to backstop everything, rather than providing liquidity through other channels. Am I making sense?
They lost their credibility. The problem, a big part of the problem with the response at the time is their sort of stinginess and unwillingness to really respond to things on the scale that they needed to be. Like they dragged out providing sufficient liquidity out through almost a 2-year period. And then at the end of that, they let Lehman Brothers fail. So a central part of why the 2007-2008 crisis was as bad as it was policymakers were very unwilling to just straightforwardly intervene. Whereas now we've gone through all that. We have Dodd-Frank, and the Federal Reserve now will just do whatever it needs to do at the moment it needs to do it, almost in advance of problems rather than just reacting to them. So, without specifics of what the Federal Reserve is going to do, Bernanke's statement like that wouldn't have done much.
It sounds to me like a lot of this was kind of, as you say, engineered, or there was a whole framework which over years became, financial sector more deregulated, etc. But on one side, I hear that the issue with these types of kind of complex financial products is that the regulators didn't quite understand them. And on the other hand, I also hear that the problem or the reason why all these kind of new laws and new frameworks were implemented is because the big guys like Goldman Sachs and Merrill Lynch, and they had a lot of influence over government policy. So, well, if you can comment on that, but also, is that influence in government policy making is still as strong as it was before the crash, or is it even worse? Or?
I think it's a mixture in terms of like what the influence versus not understanding. I think regulators certainly didn't have a framework to understand what was happening. I don't think the story that I've been telling is particularly complex to understand. There are details underneath that are very complicated, but with an intellectual framework that is like looking for these problems, looking for financial instability, you could have figured out what was going on without necessarily understanding all the details, dotting all the I's, crossing all the T's. You would have known that there's a systemic mortgage fraud that's going on and could have at least responded to that, even if you didn't understand a lot of the more complicated financial structuring things. I think there's a combination of you have, people who are ideologically committed to quote unquote free markets, to, the banks will know what to do because they're the smartest guys in the room. And I think that's like a story people are ideologically committed to more than anything else. I think you definitely have people who are influential, but I think the influence thing is more complicated than I think it's generally understood on the outside, because everyone involved has too much like self-respect to just think, oh, we're just doing something because the banks are telling us. The way bank pressure happens is you call up your friend and you give your friend a whole bunch of talking points. And that friend with talking points makes arguments in another room. And in the one sense, that friend is just a stooge for the banks. And another friend, they're actually making arguments, and there has to be other people in the room to counter those arguments and to make convincing counter arguments or arguments that are convincing in that room. And it's even worse when they can call up a senator, when they can call up a congressman and that person can threaten to hold a hearing. There's a lot of ways to make pressure that it does, yes, involve corruption, but also involves convincing people. Very few people actually go into rooms being like, I know everything I'm saying is bullshit, and I know everything I'm saying is unconvincing, but I'm going to say it because, my backers need me to say it in this room, and I'm going to get a payday at the end. People like to be flattered with this ideological layer or veneer between those things. So they don't have to think of themselves in such an unflattering light. And I think in that sense, I do think things have changed somewhat in that it's much harder to make those arguments. The forces, people making counter arguments around what's happening have more influence. People who have a grasp of the frameworks that are going on are more sophisticated, even if they're problems. I mean, the fact that, even with it being gutted, the fact that there is a financial stability oversight council that has a specific set of powers that, and that it's, the framework behind it is something that people can refer to in making arguments, in that financial instability is an academic subfield, that financial stability is an academic subfield that gets attention and seriousness that you can draw on to make arguments and is recognized is important and now can't be denied as important. That doesn't mean that stuff doesn't happen, but it happens more nakedly. Like the Volcker rule is just gutted because some Trump admin stooges want it to be gutted. That stuff is not convincing to very many people. There was pro-bank things you could do in the mid-2000s that you could convince liberals were a good thing based on the intellectual framework that was going on at the time, and that doesn't really work anymore. It's more just nakedly the Trump administration is doing this corrupt thing, and we're making these counter arguments that are based on the academic research and the academic work that's going on. And I do think that has shifted the force somewhat, and it has made financial regulation a more nakedly partisan thing. The biggest problem with everything that was going on up to the 2007-2008 crisis was how bipartisan deregulation and desupervision was at the time. So, Bush administration made things worse, but the Clinton administration made things worse, and so on. And at least for now, we don't have that kind of framework.
Before we move on to today, just wanted to ask a question on behalf of one of our patrons. Actually asked me this a few weeks ago, and I thought, I know who could answer this. And his name's Ganesh, and he wrote to me, he said, like the Fed ultimately helps banks meet their regulatory reserve requirements, does it also ultimately help banks meet their regulatory capital adequacy requirements? When I think of the bank bailout after the financial crisis, did the Fed ultimately help banks meet their capital adequacy to prevent them from going under? What were the mechanics of the process of helping banks meet this?
I think that's a good question. I think it's different. I think it's certainly true that large banks have had support in meeting their capital requirements. If you think about it, it's pretty easy in a large institution to do so. Because what is a capital requirement? Well, a capital requirement at some fundamental level is just an accounting measure. It's just, okay, you've got this amount of assets. Do you have enough equity, financial net worth, relative to that amount of assets? So all I have to do is play around with one of those two things. Probably not going to play around with your assets as a regulator. So what I really have to play around with is your equity. And the way I play around with that is I say how much your assets are worth. Because, we're doing assets to liabilities. How much your assets are worth are is truly the important piece of that.
Can I just jump in there? So we say the capital is the investor's money. You bought shares in a bank, that's the capital, right? Whereas the assets are the loans being held by the bank.
I wouldn't think of, at some point someone sold a share, and that did bring money into the company, did bring the money, equity into a company, whether it's a financial institution or a non-financial institution. But I wouldn't think of that as investors' money in the same way that I wouldn't think of deposits as their money, or that, the bank is investing their money.
Okay.
Think about it. Oftentimes when you sell a share, what happens is if Citibank sells a share to someone with a Citibank bank account, what happens is their Citibank bank account gets debited.
Yeah.
Like it's the bank's liabilities has gone down rather than its assets have gone up. The equity part is really just a way of measuring someone's financial net worth. And think about how many of the shares that a bank has sold that were sold decades ago, that at some point brought money to the company, but certainly didn't bring in money based on the current share price. I think more of what's really relevant in terms of equity is what are called like retained earnings. Basically, profits that the bank has gotten that the bank didn't then turn around and reduce their financial net worth by sending out dividend payments or by doing stock buybacks. The profits, basically can do two things. They can, become payouts to investors or payouts to creditors in some other sense, or you can just let your financial net worth increase. And if your financial net worth increases, your capital increases. So that's most of what's going on in banking. And there's also other areas where you can increase your capital. Like, for example, there's other forms that wouldn't necessarily count as profit, but will be able to protect you from loss. For example, there's loan loss reserves. And it's sort of unhelpful to think about it as reserves. It's really the bank having its financial net worth increase without its profits increasing. So that we're deciding, I'm probably going to take a loss on a certain amount of assets.
Got it.
So I'm going to book a certain amount of my increase of financial net worth, not as profits, which then would be taxed and so on, or otherwise, there would be pressure for me to pay as dividends. This is just going to protect me from loss. And there's all sorts of different things that can go into capital or into net worth, and there's different ways to measure it. There's, after the first tier, there's second tier of capital, which, can involve certain terms of long-term debt that's easier to wipe out. It can get very complicated, but at the first approximation, I think it's better to just think of capital as the financial net worth of the bank, or the net worth of the bank, their assets minus their liabilities. And there's all sorts of ways in which their assets can increase relative to their liabilities besides them selling shares. And so there's not some just reality out there, this really is what the bank's net worth is. These things have to be measured. They go through accounting rules, and these accounting rules are socially constructed. So you can choose different ways of measuring things and different ways of saying what's going on. And a big thing that happened after the 2008 crisis was changing the accounting rules around mortgages, basically giving banks, there was regulatory forbearance. I do think that's right, where you say, someone is 3 months behind on their mortgage. You don't force the bank to write that down as a partial loss or a total loss. You just wait, let things happen, and you can delay to a later time where they take losses where they've had enough profit that they can take that loss. Basically, have them increase their financial net worth in other ways, and at that moment, you could recognize a loss. Even if the loss had been recognized in 2009, maybe the bank would have failed. There are all sorts of games like that were played. One of the biggest, which really is, I think, off the radar in terms of people's understanding of the financial crisis, was the 50-state or maybe 49-state Obama administration settlement and the 49 attorney generals at the time settlement with the banks. So remember we talked about how simple point but an overlooked point, if you sell a mortgage, someone still has to collect those payments. The people collecting those payments is a servicer, not a owner. And so the big problem you ran into is banks got paid, or the servicers, which were owned by banks, got paid late fees themselves when people were supposedly late paying their mortgage. And they paid themselves big fees for processing a foreclosure. So what happened is if someone mailed in the check, but they didn't mail it so they had check tracking, you would put the check to the side and say, the mortgage payment was late. And then you wouldn't inform them, against many state laws, that they had incurred a late fee. So people would keep on sending their normal payment, and the late fee would accrue and capitalize, and they would get large interest on their fees. And then those capitalized and late fees would be paid out of a foreclosure. The mortgage servicer would pay themselves for their capitalized interest upon interest upon interest upon fees. And then the investor would get some piddling portion of the money that the mortgage servicer recovered. There's even way crazier frauds that they committed. But the mortgage servicers just committed widespread, insane fraud. Like, this is where, if you've heard the term robo-signing happen, where there was just like fraudulent signing of documents, where there's a whole other layer to that, where basically, remember we talked about how you're selling off a mortgage. Well, okay, wait, what does that mean? What does it mean for someone to transfer ownership of a mortgage? In the United States, mortgages are recorded at the county level. You have to go to some county office and you have to say, this mortgage has changed hands from this owner to another owner. We're now putting this mortgage into a trust. Do you really think that Wall Street did that? Wall Street did not do that. Wall Street did not go and pay a fee to every county recorder in the country to transfer a mortgage each time it went from a new entity and then was put into a trust. They created their own system called the Mortgage Electronic Registration System, which had no employees, which banks would donate employees to. And they say, yeah, we'll record whether a mortgage was transferred or not. Trust us, with their no employee company. And that obviously went very, very badly. So not only did you have people who were getting charged late fees and not being informed that they were charged late fees or charged other sorts of fees that then capitalized and led to a foreclosure, you also had mortgage servicers who were conducting foreclosures on homes that they did not own. They would just show up and the records were so bad, they would literally just foreclose on homes that hadn't had a mortgage for 20 years. They're the bank, trust us. But if you think about it at a broader level, you only have proof, you only actually own a mortgage if you have the legal document that says you own the mortgage.
I remember there was advice at the time saying, right, don't let them in. And if they come for your house, say, produce this paperwork, because 99.9% of them didn't have the paperwork, right?
But as we see, police people just do whatever they want. They just break down the door, whatever you want. So you think about it, that whole system actually was fraudulent. And most of the people that in this underlying system, there wasn't actually like a legal title that this person or this household owed money to this person, and they got foreclosed on anyway. And we just papered over it after the fact, saying, they have to pay a $50 billion fee, and we'll send a couple $100s to you for getting foreclosed on after the fact, but whatever. But even that, there was regulatory forbearance and bailouts even in that mortgage settlement agreement, which we can get into in a bit, but I see Patricia has a question.
It's really difficult for me to believe that this is not inherent culture within the banking system of just doing bad things if you can get away with them, basically. And it's really hard for me to believe that has changed substantially, even though I appreciate these specific ways in which they did them would be very hard to repeat them in exact the same way. But they would find other means of doing it. And there was talk as well about, not being so much about mortgages now, but about things like car loans and other types of loans. I don't know what your thoughts might be on that.
It's definitely happening in subprime auto. It's just happening on a much smaller scale. They're just not large enough to really be happening on that scale. Wells Fargo, of course, had, a whole bunch of stuff going on where, they just did the lowest common denominator thing of we're just going to make up that we opened a bank account. And you get paid a fee every time you open a bank account. And we're going to start just opening credit cards in other people's names and then charging money on it. This scale of fraud and criminality and crisis was extremely unique because you had a sophisticated facade that could overlay everything. You had all the right elements. You had all the right, ideologically infused regulators. You had the right bipartisan culture in Congress. You had the right sophisticated sounding thing that sounded like it reduced risk, which at the first layer actually did reduce risk, at least for those top tranche investors. You had people not paying attention to what was going on in 2005, 2006, 2007. We had other things going on. It's easy for if it's 2005 and I'm going around with a bunch of leftists saying, the most important thing right now is, what's going on in the mortgage market. People look at you like you're crazy. The Iraq war is going on. You can't underestimate that, other layers of criminality in the Bush administration and foreign policy actually is distracting a lot of people from these other issues, and a lot of ways rightfully. So it's, with everything going on, everything happening all at once, you can easily see why it was possible for people to wake up one morning and then everything was blowing up all at once, and then how the hell did this happen? I really think this process is unique. You need the sophisticated gobbledygook that can make people believe that there are smart people in charge who are making sure things aren't going wrong. And there is definitely fraudulence and criminality that's happening, but it's happening at other layers. The other thing I would say is so much of the fraud and criminality that was happening were happening at entities that were originally started not even part of the big banks at all, and then were later bought by big banks, but weren't federally chartered or federally regulated entities at all. They were these mortgage banks, which had specifically state charters, but weren't depository institutions, meaning they didn't deal with deposits of other people. They were these other entities, some of them even left over from the savings and loans crisis, that were, bucket shops that would just anything would happen. I mean, all the stories, mortgage brokers would get handed around meth in some places to make increase their selling power, as it were. We're talking about no one in that world is still in the banking industry. They went and worked some other medium service job, and they're kind of looking around bewildered, going that was a crazy ride I was involved in. We're talking about people who went from these jobs where they were making over $100,000 to making, if they're lucky, $15 an hour in some other job. These people, what they were compensated for was their ability to just go along with the fraud. And that does happen in other places. You can see, how low ball it is by, where it's happening. Wells Fargo, it's happening at the individual branch level, which is the lowest, people in a bank, the lowest ranking people in a bank. So I think that there is that kind of fraudulence going on here and there. There's just not the elements for it to have been the systemic thing it was, even if it will definitely heavily impact those people who are on the losing end of the subprime auto market. These are problems that are problems just because they're problems that are affecting these individual people. They're not systemic, even national problems, let alone global problems.
Bringing it to today, you, in your article, Is There Really a Looming Bank Collapse? You critique Frank Partnoy's analysis in The Atlantic, where he worries about collateralized loan obligations. You start out by comparing CLOs to CDOs and saying that that's not even a like-for-like comparison. Can you say more about that?
Yeah, I mean, this is one of those tricky things that superficially seems reasonable because of the unfortunate anodyne industry of finance. You have such similarly sounding names. I mean, it feels like you don't even have to make a case that, there's a collateralized loan obligation market. That's just like a collateralized debt obligation market. I mean, loan and debt, that's practically a synonym. So we're just talking about the same things, but we're not. I mean, the collateralized loan obligation, which is unfortunately known, it's more like a corporate loan-backed security. The analogy is to that underlying mortgage-backed security, not to the second or third layers. And there is no big credit default swap bets that are on top of this market. We're talking about a market, when you compare it to mortgage-backed securities, is 1/3 the size of what the market was then. And then if you compare that size relative to GDP, is 22.5% of the size of what mortgage-backed securities were at the time. So we're talking about something much, much smaller. And we're talking about something that is similar to mortgage-backed securities in the sense that because we're getting loans that are being securitized, those loans may be lower quality than the loans would otherwise be that banks would just hold on to their books. But the same structure actually does protect the higher tranche investors. If you're owning the top tranches of a collateralized loan obligation or a corporate loan-backed security, you're pretty protected. We're not talking about 100% loss type things, and as a result, these things are just not comparable. There's no way that this can be a systemic loss. And at the levels of default you would get at, where these AAA securities were taking big losses, there's much bigger problems for our system. We're talking about actually just an across-the-board crisis where corporate America is defaulting en masse. If corporate America is defaulting en masse, that means households are defaulting en masse. And that's potentially, could be a bank collapse, but it's not one that's rooted in structured finance. It's rooted in just, problem with loans. I mean, a lot of the stuff about structured finance has distracted people the basic, issue in banking is whether you're going to get paid back or not. That's the basic issue. And and there are various circumstances that can lead you to not getting paid back. And they're not about complicated, structured financial things. The basic issue in banking is whether you're going to get paid back. And the stupendous fraudulence, criminality, baroqueness, complicated structures, drama of the 2007-2008 crisis, I think has distracted a lot of people without a macroeconomic framework. People are looking for the next story that is like that, and that story isn't there. If it's anywhere, that story is in the drama of the Trump administration divesting in global preparedness for pandemics. Like, that's where the drama is. The drama isn't in the financial sphere. Now, because of the 2007-2008, people who, quote unquote, missed it then are always looking for it. And it's understandable why. I just spent an hour or more talking about the details of it. It's clearly fascinated me, something that I wanted to spend a number of years mastering all the details of. And, I understand the attraction to it, but at a certain point you have to realize that the old hits aren't necessarily going to, come back. And we're probably not going to get the old drama again. That's going to be a unique story from a unique period of time. And we're going to hit different problems and different issues going in the future. And this is a different crisis. It's not the financial sector that's done some complicated, terrible things, blowing up and destroying, quote unquote, the real economy. It's the real economy, quote unquote, going down because of a pandemic that is having knock-on effects for the financial sector. But also, the financial sector is, because of 2007, 2008, much more prepared for something like this than it would be otherwise.
Yes.
I think the big giveaway of 2008 is that the period before that, we had a period of relatively good growth where everybody was basically having a party. People were buying tons of properties everywhere, and it's complete opposite now. We've seen very, very little growth since then. I think we've just gotten back to the same wages that we were just before the coronavirus. So,
do you think you could tell my bank account?
No. I mean, as a collective, individually, obviously, that's very skewed. But
I think policy of division. That's a policy of division. Okay.
Yeah. Obviously, the listeners can't see this, but Patricia's wearing a crown. Where did you get that from? How did you afford that?
I just wear this in the weekends. But in a sense, what I'm trying to say, I guess, is that in a sense we were all in on it. The issue of credit was also, sustaining some growth that we were benefiting from indirectly. And then that whole thing disappeared very quickly in 2008. And now we're not seeing that. And I think that has a lot to do with the fact that the banks are not doing the same things that they used to do before.
Yeah, things were so anemic. What are the things of the last decade? There are things like Uber. There are things like WeWork, like Airbnb. What these things are predators who are predating on an underemployed, low-waged population. The things that have been anything at all have not been at the systemic level where they could really cause a crisis, and has been just the structural problems of exploitation that have come from a society that is underpaid, underemployed, and is just trying to do anything to squeeze a buck out. People haven't been doing these big splurge things where they own 8 homes and they're somehow making $350,000 a year. And the vast majority of that is just capital gains on selling, their 6th and 7th home and running through their big portfolios. You don't have that thing where suddenly every 10th person you meet is making money in ways you don't quite understand or doesn't make sense. But because they're making money, are so quote unquote smarter than you and they're better dressed than you and so on and so forth. But the closest you get to that is I'm renting out the 2nd and 3rd room in my house and I'm making $1,200 a month from that. We went from, 5 of my homes are unoccupied, but it's fine because, housing prices are going to go up another $50,000 in the next couple months to, I've got one place and I'm renting out 2 of the rooms. We're hyper using real estate rather than and hyper using things we own. On my off hours for my job, I drive for Uber to get another couple $100 It's the complete opposite of what the mid-2000s were like if you were involved with a grift. The grift then was this participating in the system where there was easy money, but it was all going to fall apart. The grift now is just exploiting yourself harder and more with just whatever little unused things that are in your life. It's the grift of austerity rather than the grift of plenty. These things are signs that you're not seeing and not going to see any of those big systemic issues. And even this, the collateralized loan obligations, what's that largely about? That's debt that's about saddling down some retail company or some rental company with a bunch of debt so you can get a little more profit out of another merger or acquisition or whatever. Are these companies weaker for having participated in those things? Yeah, for sure. But that stuff emerges as like the last way you can make money when there isn't really anything else going on. There is no other grift to really be participating in. And whether, corporate debt is at 55% or 70%, the complete collapse in revenue because we've shut down the whole economy is going to kill those companies regardless. In a crisis this big, there's almost no way you can insure against them unless we're literally talking about a society where there's almost no corporate debt and non-financial corporations are accumulating enough liquid assets for 600% of their yearly revenue. And that kind of society is a society where we'd be talking about 10, 15% deficits, where we'd be talking about, they'd be accumulating them because we'd have liquidity regulations on non-financial corporations. And that's basically a society that you could only get to where you thought that deficits were only bad because they're causing inflation. I mean, essentially, we're talking about in MMT world. The only way to let the economy pre-insure itself against crisis is to inject enough financial assets, enough financial net worth into it that it never has to worry again. There's only one way to provide the economy with that level of safe assets, and that would be an economy that people would treat as a wartime economy, because that's essentially what happens in wartime is companies are restricted from all the other things they could do. So what happens is they just accumulate money on their balance sheets and pay down their debts.
To leave it on a where shall we go from here type of a note, Nathan, what should be happening now? What should central banks be doing? What should governments be doing? I imagine you'd say, well, we need to stop expecting central banks to do fiscal policy. But obviously, I don't want to put words in your mouth. How do you answer that?
Yeah, I mean, I think that's it. I think we need much bigger things on fiscal policy. And as much as the things that have been done are much bigger in scale than anything that was being contemplated before this crisis, that's the whole thing about functional finance, about MMT, is you size your spending to the size of the crisis, not a number that sounds big to you. And this is the perfect example of that, where the numbers are bigger than they've ever sounded before, and they're wildly inadequate to the scale of what we need. That said, monetary policy is a bad way of doing fiscal policy, but you still can. And the biggest thing, of course, is just the municipal liquidity facility, providing credit to state and local governments. And the way they've structured the program is wildly inadequate. They need to go the full way. This is something I've been proposing, which I'll probably write about more, hopefully soon, is if we can provide swap lines to central banks around the world, you can provide a swap line to local and state governments. If anything, it makes more sense to do that than the swap lines around the world. And there's more of a mandate to support local and state governments in crisis than to support foreign governments as crisis, even if I do think that is necessary as well. And, these are governments. They're not, private entities where you worry about this quote unquote subsidy you're giving them. You should be providing, the same thing you're giving around the world. Unlimited swap lines, unlimited credit lines at low interest rates, and let them borrow as needed. And if you want some sort of restriction principle, require them not to cut taxes or require them not to cut public services, whatever it is, and limit them to only increase their budget, say 5%. But what you would be doing is letting their automatic stabilizers work. You would be letting, payouts increase because people are poorer, and you would be letting tax revenues fall because people have less income and because asset prices are lower. And you would be letting those automatic stabilizers work and let them run whatever resulting deficit, knowing that the deficit is coming not from some discretionary policy of theirs, but just how the automatic stabilizers run. And, that wouldn't do everything, but it would go a long way, because a lot of what really causes the problems is the austerity at the state and local level, where not just are you not increasing spending as necessary, but you're actually trying to cut spending or raise taxes to deal with your financial problems. That's my big, top thing for the Federal Reserve to do. But then, of course, Congress, it's a whole different thing.
Patricia, do you know, do we have the same problem here with the way our municipalities are funded? Or have they already been hollowed out anyway? So.
I would have to look into that. What I do know is that their budgets have been cut by 50% since 2010 or so, and that the ultimate aim is actually for them not to get any funding at all from central government. Just to give an indication of how brutal things are about to get if we carry on in this direction. But they would be expected then to raise all their income from taxation. And that would mean, obviously, that richer areas would get better local services. And
initially, but that it'll be like the Eurozone crisis, basically, wouldn't it? Just on our island, basically.
Yeah, basically.
Yeah, no, I think that's basically, it's, the state and local thing is a problem everywhere. It's the worst in the U.S. because the U.S. provides the skimpiest support. The U.S., of course, doesn't have national health care. It doesn't have universal health care. And so, this is something I wrote about early on the crisis, is that Medicare for All is a great automatic fiscal stabilizer because it gets money out the door when you need it, especially in a pandemic where demand on healthcare spending, increases dramatically. That means we're talking about increase the deficit, and that's supporting the economy right when you need to do it. Whereas instead, with the U.S. system, we have things like we're matching you for Medicaid. So the states have to be spending a certain amount for Medicaid spending to increase in a crisis. But of course, they go around and they cut Medicaid, and they even cut Medicaid in the crisis. Andrew Cuomo in New York governor was looking to cut Medicaid right up until the coronavirus crisis. And he almost pushed through cutting Medicaid during the crisis and has now delayed it a fiscal year. So like the next fiscal year, we have Medicaid cuts coming down right in the midst of the coronavirus depression. And then, of course, we have a healthcare that's tied to employers. And we have these big subsidies for employer-provided healthcare. Well, what happens in a depression? Employment collapses. Employment especially collapses for people who have health insurance in their jobs, which means that the amount the U.S. is spending on healthcare decreases automatically as people lose their jobs. So this subsidy structure, even as it's unequal, unjust, and all these other things, is actually also pro-cyclical in the sense that, we provide this subsidy that goes for employer-provided healthcare, which then collapses in recessions and depressions. So in the U.S., we are especially stingy providing money to state and local governments. And we have all these other burdens that have to be attempted to made up at the state and local level, which makes depressions and recessions especially bad in the U.S. and lead especially harshly to austerity because there's so much that people rely on at the state and local level.
And obviously, and that whole thing has got a racial component to it that's very, very ugly as well. So moving on to your article called The Federal Reserve's Coronavirus Crisis Actions, and there's a piece in American Prospect by you, When Americans Don't Riot, Politicians Feel Unrestrained. But you've written, on one level, what's happening regarding social unrest has very little to do with the intricacies of central banking. On another level, they are intimately related. Can you say more about that?
Yeah, so at the superficial level, you'd go, what's going on right now is about policing. And policing is a state and local thing. It's a state and local budgetary thing. And, the history of policing in the United States goes back decades, goes back centuries. What does this really have to do with central bank policy or with, macroeconomic policy in general? When you go deeper, it has a lot to do with it because, the civil rights movement was also a movement against police brutality and was providing essentially, in some sense, like a social democratic or a socialist alternative, depending on which parts of the civil rights movement we're talking about. And but even less remembered than that is that it was also a movement against police brutality, is that it was a movement that had very definite set of economic thought, that things like a job guarantee, a legally enforceable right for everyone to have a job, was at the center of the civil rights movement and was something advocated across civil rights leaders, whether we're talking about Martin Luther King or further to the left than MLK and, of course, Coretta Scott King as well, which we talked about in a bit. And so they were putting a very direct challenge to economic policymaking in the country at the time. And at the same time, you had rioting that was happening that people like Martin Luther King were positing themselves as an alternative to. He says, that our summers of rioting are generated by our winters of neglect. And, he's making the case there that, if you want to stop the rioting, you should implement a social democratic program, that you should guarantee people a job, and you provide people with this basic economic livelihood that can support them and end deprivation in these communities. And that ending deprivation in these communities is a part of making communities alternatives to the way that they're being policed at the time. It's essentially like an occupying force. And the counterattack to that, after Martin Luther King is assassinated and after a whole bunch of set of Black Panthers are assassinated and social democratic left is fractured in many different ways.
But also targeted by COINTELPRO and pretty much basically being used as a sort of ideological police force, I guess.
Exactly. And after all that, you get what the alternative is. And the alternative is incarceration, is even more policing. We double down on the fact that these are occupying armies, but this time we put people into prisons, and we fill up the prisons to drain the country of, undesirables. And even if, they do eventually get back out, they're structured and broken and just put into disarray by being in prison for over a decade, which is a traumatizing experience, or for 20 years or so on and so forth. And we fill up the prisons with young people, disproportionately Black, of course. And as part of that, we also now have the scope to conduct austerity. And this is one of the things that I dug up with the help of the historian David Stein, is Alan Greenspan's thoughts about this. Alan Greenspan is remembered as, he, of course, was the Federal Reserve Chairman during most of the lead up to the financial crisis. He was Federal Reserve Chairman from 1987 to 2006, which is, a long, long reign for one individual to have on one of the most important institutions in the country. But he's even more influential and powerful figure in the United States than people even remember, because he also was the chair of the Council of Economic Advisors under Gerald Ford, after Nixon, so 1974 to 1976. And that's an important thing. First of all, it recontextualizes that history of the 70s to think about this loony libertarian Ayn Rand fan being, in the White House, brings Ayn Rand to the White House to meet Jerry Ford. You can think about, the scale of that right-wing government that is filled with Donald Rumsfeld and Dick Cheney and Alan Greenspan and Kissinger, and all the devils are there, literally. And they pursue a policy of austerity to deal with the mid-70s inflation, basically following up with what Nixon's policies were before he resigned. And Greenspan, in this reflection on his time at the Council of Economic Advisors, straightforwardly said that he had no idea how bad unemployment was going to get. If he had proposed bringing unemployment to that level, they would have laughed out of the room, and they would have thought that, the country was going to fall apart in chaos. There would be mass rioting for unemployment at that high level. That unemployment level, of course, was 9%. 9% in the early 1970s, where the minimum wage was much better, where the social benefits were much better, where welfare still in some tattered form, but still in some form existed in the country. Nonetheless, he thought 9% was a crisis, but because the left had been shattered, there was, in his words, a failure of social radicalism to emerge. And as a result, this set the stage for larger and larger amounts of austerity, and eventually the Volcker shock of raising interest rates to 20+% in the late 70s and early 80s. And that this is the kind of key unremembered part of this history, is the austerity of the 70s and 80s and 90s was only possible because elites had felt that it had been demonstrated that the left had been broken, that the population more generally, even beyond just the left, the population would just accept things, that bad things would happen, their livelihood would be destroyed, and they would basically just more or less just sit there and accept it. And I think that tells you a lot about how policies have been able to get worse and worse and worse and worse. Is, for the most part, not completely, but for the most part, there's been a remarkable amount of consent, implicit consent through lack of action to what's been happening by, not acting as your life gets worse and worse and worse, as your children's fortunes get worse than yours. And you just go down the line until you get to the point where you get to the current coronavirus suppression, where the U.S. government is basically explicitly letting hundreds of thousands of people die from their failure to mobilize, and even having a president who's encouraging places to open back up without the adequate protection you would need to do that, which predictably makes cases rise again and kills off more people. We've reached this sort of precipice point where if people had consented to this, if things had just kept on going as it was going, what politicians would learn is they could do anything. They might get voted out, they might lose elections, but they'll never have just such a fundamental challenge to their power and their actions because, even during the coronavirus suppression, no one said anything and everyone just sort of shut up, voted and took things as they came.
Which is a centrist hymn that they all like to sing, isn't it? Just, shut up and vote. That's not going to save any lives right now.
I mean, one of my favorite bits was in Kentucky for the primary, there was one polling place for over 600,000 people in a predominantly black area, of course. And at a certain point, the doors were locked, even though polling places were supposed to be open till 9 p.m. And the candidate was really interested in polls being open. Charles Booker got an injunction to get the polling place opened up. And even though he told them we've got the injunction, they're supposed to open up, they still, for a period of time, they weren't opening up. And people were just banging on the windows to get them to reopen the polling place. And someone quote tweeted the video of that and was just like, I appreciate the sentiment, but the place to really make your voice heard is the ballot box. And it just going with the full bit. It's like, how if you're being blocked from the ballot box, how do you solve your problems with the ballot box? Like, it's this reductio ad absurdum of the don't boo vote kind of rhetoric.
The person that quote tweeted that, was that a joke?
That was a joke. But
good.
How fallen things are that a lot of people weren't sure whether they were joking or not.
Yeah, absolutely. Yeah.
To give you another example, actually, that's really interesting because here, when we had the Brexit vote, and that was seen by many as one of the most democratic moments in a very long time here, even, with all our flaws and everything. And when it was clear that politicians in Westminster had no intention or wanted to reverse the vote, if they could get away with it. There were rumors that there would be things like riots in the street and things like that. And there were quite a lot of people who would say things like, democracy is an outlet. If you give people a choice, then they don't have to go out and riot. They don't have to do these things. And I agree with it then. But now those very same people, when they see the riots in America, they tend to be, why can't these people just be civilized about it and just kind of, why can't we just talk about it? And it's really strange how they cannot apply the same kind of thinking when they see other people, reacting what they believe to be unreasonably. Or
I also think, if you've never had a knee on your neck from somebody who's like supposed to be paid to be, serving and protecting, you're not gonna understand why this is happening,
And on that note, actually, since we were talking about, I don't know if I have time for just one more question. Speaking about Brexit, a lot of people here, as you know, our financial system kind of takes quite a big chunk of our economy. And a lot of the arguments, a lot of the debate was about, oh no, we can't do Brexit because we will ruin the city and that will, by extension, ruin us. And now that they're going to have to come to a deal soon, it's speculated, which way this is going to go, because some of the things that were promised to Brexiteers are also pretty against the city's interests. How worried do you think we should be about getting in the city's way of doing business? I mean, I suspect you think that in the long term, it would be a good thing to restrict their activities substantially. But in the short term, will we see a really bad things happening as a result?
I'm not particularly concerned about the restrictions to the city. I'm not particularly concerned about the shrinking the financial system. My concerns are much more at the operational level. My concerns are much more like whether you'll have agreements that will operationally let imports and exports go through ports. Like, it's a lot of this stuff like that, sort of just mechanical stuff where there's these international standard setting organizations like the International Standardization Organization, actually, the ISO, and other organizations which structure these standardized processes that work through certain institutions, and the EU has taken up that part of standardization processing for the countries within the EU. And most of my concern is just about all of those international standards which have to be renegotiated and reset with a country that's exiting the EU. That's always been my concern with Brexit. I have never really been concerned about the stuff like, oh, you'll get like less, good trade access on the like price level or the tariff level. I'm not super concerned about that. I'm sure it can have some minute negative effect. I'm not really concerned about the stuff about like shrinking the financial sector, shrinking the city. I think is totally spurious. Most of my concerns about those operational questions, which as far as I've seen, which I admittedly have paid less attention to the last couple of years because, there's only so many years you can pay attention to Brexit, even as, I know you guys are just stuck in it, but, at a certain point, we've got other things going on. And I have an excuse now. There's a global depression. I've actually, but that was basically my concerns. And as far as I can tell, we still have those same problems that the conservative government has not moved forward with dealing with any of the operational issues in a serious way. Which could point a way to something. It's possible that, a Labour government, maybe not the current leadership, but a Labour government could structure dealing with those operational issues in a way that, you can get out of the current mess with the minimum of pain. But it doesn't seem to me like the conservative government is really up to the challenge or taking seriously dealing with these sort of operational issues, which are not something economists really pay attention to. I think the good rule of thumb is stuff economists talk about, like, oh, you're not getting enough good trade access, or harming the city is gonna, really harm Britain's place in the world's economy. The stuff economists care about, I think, is basically nonsense. But it's the stuff economists don't pay attention to, these sort of just operational questions that underlie an economic life that we all participate in, that I'm worried about.
Do you think it's fair to say, all those companies that are, sending us stuff, they still want to send that stuff? There's a lot of money at stake, and the places we're exporting to, those companies want to get the income from their activity. And I just always trusted in the sort of, I guess, venality of those to push the right things through, or the right things for them, obviously not the right things.
I think that there's an element of that, but I never underestimate government. Government incompetence, especially the incompetence of right-wing ideologues in government. Take the United States right now. There's a lot of corporate incentive to get the response to coronavirus right and get the economy going again. There's a lot of incentive to actually, do contact tracing correctly and to, actually stamp out the virus so that you can get the economy going more quickly. And the U.S. is incapable of it because of the way the government currently is structured and the incompetence of the leadership, both in Democratic states and the Republican states, but also, of course, at the federal level. So these sort of just ideological partisanship things, as well as generally our government's deformed capacities to respond to operational problems, does not make me confident that corporate interest can win the day. I think the lesson, in a lot of ways, the lesson of the last decade is that government is always more incompetent than corporations are interested in the bottom line, especially when they're ideologically committed to their own incompetence. We're bad at this. That's why the corporation should be in charge. Well, it makes them hard to be good at the certain smaller set of functions that even the corporations want them to be good at.
They have to outsource everything to technocrats, basically, because they can't make decisions.
But then they throw away the technocrats.
Yeah, fair enough.
We're devolving our system to have the technocrats decide, but then technocrats are kind of expensive, so we're cutting the budget on the technocrats. Yeah. So there's actually no one who's captaining the ship.
Well, on that positive note,
title of the episode: there's no one captaining the ship.
But there's hope ahead, right? Everything will be okay. There's hope.
Well,
oh no! Don't look at me that way.
Yeah, I like icebergs.
Hey, it's been fascinating crashing into this iceberg, I would say personally. So never been more intellectually engaged. So,
well, every cloud has a silver lining, and acid rain. All right. Well, look, it's been great to talk to you, Nathan. We're going to link to all your stuff, but I reckon the primary way to stay current with Nathan Tankus, correct me if I'm wrong, is Nathan Tankus' Substack. And that's where you can also support Nathan financially for a very reasonable rate. And also there's tons of free stuff, public stuff there, but there's also premium content. Do you want to just tell us a little bit about that before we go, Nathan?
Yeah. There was a moment I realized what was going on. And then a week later, I decided, actually, I should be writing about things. So on March 19th, I started a Substack to cover the coronavirus suppression, which I think still was a little bit early in terms of people fully having a sense that this was a global depression that we were going to be stuck with for a while. And it's exploded. I mean, I've got a lot of mainstream press coverage on it. I went on Bloomberg's Odd Lots. I've been quoted in a set of mainstream publications all over the place. I've got a pull quote on Federal Reserve's policy actions in the Washington Post. So this has sort of been like a level up to my public prominence. And the backbone has been what I've been writing on my Substack, nathantankus.substack.com, where you can support me. And I've been writing full time about various different aspects of the crisis, especially my early stuff focusing in on the details of what the Federal Reserve's crisis actions were. And that has been a big part of what has a lot of people paying attention to me. And it's been an interesting kind of wild ride, I would say. But the backbone is the crisis that's ongoing. And the thing about getting interested in this kind of thing is that it's a counter-cyclical business. The crises go down, people are less interested in hearing about financial instability all the time. Crisis happens, and suddenly, someone writing about crisis is the most fascinating thing in the world. And suddenly people really want to understand what the Federal Reserve is and what it does all at once. I've definitely benefited from that. It's weird to benefit when everything's falling apart.
We benefit from your insights. So
thank you.
Yeah. By all means, keep going.
There's a great subsection in the Substack, isn't there, of Central Banking 101 posts, which come out weekly as well, which is a great place for beginners to go, I'd say. So great stuff, Nathan. I mean, we're all still reeling from the last financial crisis. Yeah. It basically took me 5, 6, 7 years after the last financial crisis to find Patricia and say, hey, let's do a podcast. So we're still looking backwards. And then this whole thing comes along. So, I'm glad you were early for this one.
Yes, thank you. One last thing, of course, is plug coupon code for the episode, nathantankus.substack.com/MMTers. So MMTERS. And you can get a 45% off coupon code.
Great news. And you said -MMTers. That's definitely dash, not slash.
Oh, slash. Sorry. I always get that mixed up. It's slash.
Thanks, Nathan. It's been great to talk to you. We'll catch up with you when you're charged up again, and you must be writing 24/7. So thanks for taking a break from that.
It's felt like that for sure.
All right then. All right. Well, bye everybody. Thanks for that.
Thank you.
Bye. Thank you very much.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month, and get early access to all our episodes and patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Editing and post-production was by Damien Caldwell. Thanks for listening.